the bond market was down every day on the week. It had a 4-day losing streak, big losses, until we finally saw a rally on Friday. The bond market recovered part of its losses. It was a pretty big rally too, but not nearly big enough to recoup the bloodletting of the previous 4 days. And the catalyst for that rally was a weaker than expected jobs from the Labor Department. I want to stay focused right now on what was going on in the bond market. All of the yields ended the week higher, above 4%. And one thing that was very significant was that we had a uninversion of the 30 and the 5 for many months. I forget how long, but for quite some time, the 5-year yield had been higher than the 30-year yield. Well, now the 30-year yield closed the week at 4.214, but the 5-year closed at 4.163. Now, you still have an inversion of the 5s and the 10s, but no longer of the 5s and the 30s. And that is the yield curve starting to normalize, but it has a long way to go because, the last time we had a short-term rates as high as they are, they're about 5.25, 5.5. The yield on the long bond was, I think, 5 or 6%, somewhere in that range. So we still have a long way to go. It's because investors still expect, or bond traders still think the Fed's going to be able to bring interest rates all the way back down, and we're going to go back to that super low interest rate environment where inflation is 2% or lower. That's never going to happen. The bond market just hasn't priced in reality yet. It's still priced for a fantasy, although the smoke is kind of clearing rapidly now as bond yields are starting to move higher. But the key is the stock market has not come to terms with even what's already happened to the bond market. Forget about what's likely to happen. Because also, as I pointed out in the last podcast, the technicals look horrible. The bonds, to me, look like they're going to get killed. And that's why they got killed so much this week, was because the technical breakdown happened the week before. And as I mentioned, there's a lot of people who were trying to pick the bottom in the bond market. They thought they were going to make money in the long end of the curve. They expected a rally, and now they're disappointed. And I think a lot of people have to throw in the towel on that trade. And so there's going to be a lot of selling. But higher interest rates are a problem for the stock market. The stock market should be a lot lower right now, given what's happened in the bond market. Now, yes, the market closed down on the week. And in fact, there was a pretty solid reversal on Friday also, because we had a big rally in the morning on the weaker than expected jobs number. Bad news being good news. But the markets rolled over. And also you had earnings that came out, Apple and Amazon. Amazon was a big beat, and the stock was up about 10% early on. I think it closed up about 8%. And Apple also beat, but iPhone sales missed. In fact, that was the third quarter in a row, I think, that we had falling iPhone sales, and Apple was down. It closed down like 4.5% or so. So early on, though, the losses were a lot smaller. And I think as people started to think about what that means with iPhone sales being down, that weighed on the market. And we had this reversal where we closed kind of near the lows of the day across the board. So maybe we have finally begun. I've been talking about that on the last few podcasts. I've been expecting a sell-off in the stock market. We just haven't gotten it. And one of the reasons is the backup in yields, which is continuing. And as I said, there are so many reasons why rising bond yields are negative for stocks. I mean, first of all, by definition, you have to discount the future earnings by a higher rate. But bonds compete with stocks, right? People can buy bonds instead of stocks. And if bonds are offering a better yield, well, there's competition for stocks. So you look at what their dividends are, the dividends aren't rising. And also, a lot of these companies have debt. That debt's going to mature. They're going to need to roll it over. And if bond yields are higher when they roll it over, that's a higher interest expense. So that reduces corporate earnings. So you're reducing the numerator, and then the denominator is higher for the discount. And so, you're getting it from both ends on the stock market, but also rising interest rates make a soft landing less likely, because the rising interest rates are problematic for everybody. Everybody's got debt. and higher rates is going to weigh on the economy. Now, personally, I think the probability of a soft landing is zero, but investors don't think that. In fact, the Fed, as I mentioned in the last podcast, at the last press conference after that last rate hike, Powell admitted that the Fed no longer thinks we're even going to have a mild recession. So they've taken any recession off the table. They still think that the most likely scenario is no recession at all. And so they couldn't be more wrong. But rising interest rates put that into question. But not only did interest rates continue to rise, the other trend that continued was oil prices. Oil prices were up again for the sixth consecutive week. They closed near the high of the day, around 82.80. Early on a Sunday night, oil's now above 83. We've actually taken out, I think, the intraday high from Friday in New York. We're now at 83.4 a barrel. So we're up better than 30% now in this oil run in the last few months. And the oil chart looks very bullish, just like the bond chart looks bearish. In fact, it makes sense that these charts would, if my theory is correct, that what's driving bond yields lower and rates higher is inflation. It's not that the markets are worried about the labor market being too strong or the economy being too strong. They're worried about inflation. And that makes sense because oil is a big part of that. Inflation is driving oil prices up, and it's driving bond prices down, which means yields are up. But that also weighs on the economy and makes a soft landing less likely if we've got higher oil prices that everybody is going to have to deal with.